We're spoiled because we haven't even got to the end of this year and we're already going to get your outlook for next year, which is what?
Well, we think that the expansion will probably continue into 2019. It's going to grow more slowly, but throughout this long economic expansion, we've described it as a healthy tortoise. The image for 2018 was a tortoise on sugar. It picked up. I think the image for 2019 is a marathon tortoise because it's going to slow down to about 2% growth again, but we think it'll keep going. And if this expansion makes it past next July, it'll be the longest of all the US economic expansions going back to the American Civil War. So it's going to be a record-long expansion. We think it is sustained, but I think that downshift to 2% growth has got lots of interesting implications for asset prices.
And of course, one place that we would look, David, is international asset prices. What are you thinking in terms of rotation away from the U.S. domestic market into international plays?
Well, we think that will take place. We're sort of hedging our bets a little bit in terms of how fast it takes place next year. But what's basically going to happen next year is by about the middle of the year, the U.S. economy will shift down. Now, if it shifts down in terms of growth, and the rest of the world is able to pick up in growth, then you may see the dollar begin to weaken, and I think you could see international assets, international equities do much better relative to the US. But it really depends upon a slowdown rather than a stall out. If you see a stall out in the US, then I think that could be problematic, particularly for emerging markets. What I will say is that over the next 5 years, I mean, it's not just our outlook for 2019, it's about the investment environment for a long-term investor in 2019. And when you think about it from that perspective, we do think that international equities are cheap relative to US equities. We'd want to be overweight relative to a normal portfolio at this point.
If it begins to happen the way you're forecasting that it will, and you're an economist, wouldn't we get a response from the Fed? Wouldn't we get a stronger put, for example, a Powell put?
Well, I think there is so long as we have a slowdown in the economy rather than a stall out, I think the Fed will still raise rates in December, but also in March and in June of next year. So that takes us up to 2.75 to 3%. At that point, I think that they will stall, or they'll sort of suspend further rate hikes with the thought that they might come back in December. But I think what's going to happen is we're not going to see inflation take off. I think the inflation rate a year from now is going to be exactly where it is today. And without higher inflation, and with the economy growing at a slower pace, I think the Federal Reserve may stop there. So I think to some extent, yes, that's right. It is a Powell put in that I think they'll stop at neutral. They won't go beyond neutral anyway. And then if the economy were to weaken, then maybe you take those March and June rate hikes out. But that's not our base case. Our base case is we get rate hikes in March and June, and the economy just slows down to about 2% growth and sort of holds at that pace.